when looking at exclusions and exceptions, what is that focusing on? What's the topic?
It's what's excluded in a policy.
Correct. It's the policy.
What wouldn't be paid for.
Yeah, so you're looking at what's how can I say, specified in the actual policy is going to be the terms and conditions. So when we have exclusions and exceptions, okay, both are similar, but they're a little bit different. Okay, so when looking at an exception to a policy cannot be deleted, because an exception is basically what the insurer is saying they're not going to cover, and that needs to be specified in the policy. So that needs to be accepted, okay, as an exception. Right, so an exception, as in EXCEPTION, okay, let me write that word down on over here, okay, just as a note, exception. Okay, an exception is something that is specifically excluded from the policy, brackets, it's part of the policy, not deleted. Okay, so that's something that you'll see in the actual policy. So remember, with insurers, do you agree insurers want to specify exactly what they're not covering rather than everything they are covering? Does that make sense?
Yes, yes.
Okay, because for them, it's easy to say, no, we're not going to cover this, this, and this, okay, because it's specifically explained, okay, or specified in the actual policy. So that's what an exception is. An exception means we're not going to be paying out that claim for these scenarios. Right, it can't be deleted, meaning you can't take out that exception if the insurer doesn't want to pay for losses or damages from earthquakes. They're not going to pay. It cannot be taken out of that particular contract, okay, in the policy. Right, so you get different types of exceptions. Okay, exceptions are things that the insurer has specifically mentioned in the contract that they're not going to cover. Okay, that's an exception. Right, then you get an exclusion. Right, so when looking at exclusion, okay, we're looking at something that's going to be taken out of that contract. Okay, so when looking at policies, you can have an exclusion, okay, which would be something that is taken, or let's put inverted commas, taken out of the cover. Right, so for example, if we're looking at, let's say, householders insurance. So householders insurance will be looking at cover for property, movable property. So your laptop and other. Do you agree?
Okay. Yes.
Okay, so if that's the householders policy, meaning we're covering the laptop would be covered for loss or damage at the home. Okay, because that's householders insurance cover. But I don't have all risk. So what happens if I take the laptop and I take it to the office, and on the way to the office the laptop is stolen, damaged, or lost? Would they cover that?
No.
No, they wouldn't. Okay, because there wasn't all risk cover. So exclusions are things that won't apply to that specific scenario. So the laptop will be covered so long as it's at home, okay, in terms of the householder's policy. Okay, it's excluded from the householder's policy if the laptop was on the road traveling around town, if that makes sense.
Yeah.
Okay, so an exclusion is something that can be deleted. Okay, because if you delete it, then you've basically got all risk cover.
Okay.
Okay, and then obviously you get things that are called extensions. So extensions meaning you could extend the cover to take other considerations into consideration. Okay, so there's extensions, there's exclusions, extensions. Okay, this will be broadening the scope of the cover or the policy. Okay, then we're specifically including something else. Okay, we're extending the cover basically.
Okay.
Okay, yeah. So an exclusion, all right, can be deleted. Okay, and it doesn't. It's something that. How can I put it? It's an exclusion that doesn't always apply. Okay, so sometimes it applies, sometimes it doesn't apply. Exemptions, all right, always apply. Okay, exemptions.
Okay.
Not exemptions. Okay, I'm thinking of like exempt from something. Okay, exceptions. Okay, exceptions. All right, exceptions will always apply. Okay, exceptions.
Okay.
Exceptions will always apply, meaning they will always not cover certain events, okay, as specifically included in the policy. It's excluded, okay, because it's an exception, okay, an exception to the rule.
Okay.
Okay, it's quite tricky because of the wording.
Yes.
Yeah, so I get why it's a bit confusing. Yeah, it is something, and they do test it quite often. They do test questions looking at this concept. Yeah, so we'll see if there are any questions in this exam paper. Okay, maybe there is. If there is, then we'll discuss that again. Okay.
Okay.
All right. So, is that all right?
Yes, it is.
Okay, good.
Thank you.
No problem. Okay, so let's start then with October, November 2016. We've obviously got two sections to cover. Section A is the 20 multiple choice questions, and section B is then the long questions, well, true and false, and then the long questions. Okay, so you were given 3 sections in this paper. Okay, a bit different from other past papers. In the past, they normally just gave multiple choice and long. Okay, and also in the much older papers, they used to test long-term and short-term insurance. Okay, so if you are referring to past papers that are older, just bear that in mind, because they basically took risk and they converted it into 2 separate modules, the 3701 and the 3702. 3702 is the long term, 3701 is the short term. Before, in the past, they just had one module called Risk 3701, and it tested the long-term and short-term. Okay, so don't worry if you see other things like pension funds and provident funds. Those are all long-term insurance policies, and that'll fall outside the scope of this module as it stands today. Okay, so the newer exam past papers only focus on short-term. There's no note about any long-term insurance policy. It's all focused on short-term. Okay, so they've obviously split it into 3 sections here, A, B, and C. C is the written, okay, 6 paragraph questions, and then you've got 10 and 20 multiple choice. Okay, so 10 true and false, 20 multiple choice. Right, so let's start with section A, MCQ. Right, question 1 is talking about a business has a current ratio of 2 to 1 and an asset test ratio of 1.5 to 1. Okay, so looking at that from your finance knowledge, you know this is a liquid business. Okay, there's liquidity in this business. Their current assets are greater than their current liabilities. The business has a risk-seeking attitude towards risk and is considering a risk retention program. Okay, risk retention meaning we're keeping the risk. So we're going to have to either self-fund it or we're going to have to accept the risk.
Okay.
Okay, with due consideration of these ratios and the intention of the business, indicate the correct statement below. Okay, so we need to know which of these statements are correct. Right, the first one says the ratios of the businesses are not favorable for a risk retention program. Would you agree with that?
No.
Okay, they are favorable. Okay, so that one's out.
Yes.
As long as it's greater than 1, those are good ratios.
Yes.
2, a higher level of loss assumption based on working capital guidelines is possible. Okay, obviously, higher level of assumption based on working capital guidelines. We need to think back to those guidelines in terms of working capital and what was the percentage. Okay, so last week we covered those study guide chapter topics, and one of the topics was the how much should a company self-fund. Can you remember that?
Yes. Yes.
Okay, and then we summarized it in the notes. We had like percentages for all the different scenarios. Okay, so that's something to consider. They didn't ask about the percentage, but just something to consider here in terms of, are we going to take on more, let's say, risk based on the working capital requirements? It is a possible consideration. Okay, so we'll keep that one aside. Okay, number 3 says the business is not in a good position to handle current obligations. That's definitely false.
Ouch. Yeah.
The current ratio is indicative of a illiquid working capital position. That's also false.
Ouch.
Alright, so the right answer is 2. Okay,
It's true.
2 means if I have a good, let's say, liquidity position in the business where I have working capital positive, I can then assume more self-funding in terms of risk. I can retain more risks within the business. Okay, so okay, let me shrink this. Okay, there we go. As you can see both. Alright, so question number 1. Option 2. Okay, question 2. Mr. Naidu has both a personal accident and a whole life insurance policy. He works in a mine as a shaft manager. Okay, during one of the shifts, he gets injured in an explosion but survived and is awarded sick leave for 6 months. During this time, he is killed in a motor car accident. Shame, this guy's got such bad misfortune.
Yes.
Okay, his dependents will. Okay, so now we need to consider what will his dependents have in terms of their rights. Okay, so do you agree? We've got a policy here, or we've got 2 policies actually. Okay, we've got a personal accident and we've got a whole life insurance policy. And he was injured during an explosion but survived and was awarded leave, but then during that time he was killed in an accident. Okay, so whole life insurance policy, that's long-term insurance actually. Okay, they shouldn't really be testing those types of concepts here if they're focusing on short-term. Okay, remember whole life is long-term, personal accident, that's short-term. Okay, because it's looking at injuries that are sustained either at work, okay, or personal accident. Okay, so things that harm or injury or let's say events that can cause loss for that particular individual. Okay, so which of these do you think is correct? Well, the first one says have no claim against the personal accident as his death was not work related. What do you think?
No, that one's out.
Okay, personal accident, in terms of he was killed in a motor car accident. Okay, so that's a consideration. Let's, well, not a consideration, because if we're considering what personal accident is, what is personal accident?
It's when you have a car accident.
Personal accident? Motor car insurance?
No.
Personal accident would be like getting injured at work.
Yeah.
Okay, so like slipping down the stairs.
Yeah.
And injuring yourself. Okay, so personal accident, let's just check. Okay, there. Personal accident is on page 137. Just to read the definition here. Okay. Personal accident is compensation, okay, for someone's life against injury or death. Okay, what is covered? It's someone who is injured or killed by violent, external or visible means as a direct result of an accident. Okay, was this an accident?
Yes.
Yes, it was.
No. Yeah.
Okay, it was an accident. It was a car accident.
It was a car accident.
Yeah, so personal accident insurance compensates the insured if they are injured or killed by violent, external or visible means as a direct result of an accident. Okay, so that would be a possible consideration. Have no claim against the personal accident as the death was not work related. Okay, that wouldn't, the not work related part is the problem. Do you agree?
Yeah.
Okay. Alright, so number 2, not be able to claim from both policies at it will be regarded as double indemnity. Okay, this is an interesting one. Okay, whole life insurance is going to cover what?
That's his life policy. It will cover his life
policy, correct. Okay, that's if he dies, then there'll be a payout for his family.
Yeah.
Okay. Alright, number 3, be able to claim the full benefits of both life insurance policies. And then we've got be able to recover the damages caused to the deceased motor vehicle from. Okay, that doesn't make any sense.
Yeah.
A deceased motor vehicle from the personal accident policy. That's definitely out.
Yeah.
Okay. All right. So you're definitely choosing between 2 and 3.
3.
Okay. Can policies pay out twice?
I think with the personal accident and the life insurance, yes.
Okay, so here, be able to claim the full benefits of both life insurance policies.
Wouldn't that be like something like double indemnity or something?
Yes. Okay, so in terms of, so if you actually consider what personal accident is, okay, if I'm looking at personal accident insurance, it's cover if you're killed by violent external or visible means as a direct result of an accident. Okay, in terms of the different benefits, obviously you could have benefits ranging from like a death benefit, you could have a disability benefit, or even temporary disability. Okay, or even medical expenses possibly could be covered as well. Okay, so those types of policies cover you in the event that you have sustained loss. Okay, would this meet the definition of betterment? Okay, remember betterment was you're ending up better than you were before.
Yes, I remember that.
If he claims twice. Because what are they trying to claim for? They're trying to claim for death.
Death, yeah.
Okay, so if he was injured in an accident but he didn't die, would the whole life insurance policy pay out? Probably not,
no.
unless there's a disability portion that's accessible.
Yes.
Okay, but the personal accident would pay out because that could have a disablement or temporary disablement. Do you agree?
Yes.
Yeah, so I would go with not be able to claim from both parties, and it'll be regarded as double indemnity.
Okay.
Okay, because it's one event, it's the dying. Okay, this guy was killed in an accident. Okay, so if he's claiming, okay, would he be able to claim twice? Okay, if he is claiming twice, then he's being there's a betterment involved there because now there's enrichment. Okay, because both policies are going to be paying out here. Right, because here we've got Mr. Dadu has both a personal accident and a whole life insurance. Yeah, whole life would be his life cover. Personal accident would be being in an accident. And if he's working on a mine and he was killed in a car accident, the car accident would be claimed under personal accident. That could be part of the compensation for injuries or death. And then the life cover would also have to pay out. Yes. Okay, so definitely there'll be a limitation on how much is paid out. A limitation will be applicable. Okay, because remember, insurers need to obviously cover loss. Okay, so if they are covering loss, they're either going to put the person back in the position they were before, or there's going to be some form of compensation to the loved ones for the person having died.
Okay.
Okay, so yeah, so I would be going with not be able to claim from both policies. It'll be regarded as double indemnity. Indemnity, actually, if we think about indemnity, what is indemnity? It shouldn't be indemnity, it should be compensation.
Yes.
Okay, because you can't indemnify someone from dying. So actually it might be incorrect then. Because double indemnity, the word indemnity refers to putting someone back in the position they were before. Okay, so then actually if we look at the wording, that would actually be incorrect. So then 3 would be, well then we have no other option other than 3. Unless number 1, let's just check number 1, have no claim against the personal accident policy as his death was not work related. Okay, no, that wouldn't be applicable. Not be able to claim from both policies. It'll be. I just don't like this word here, indemnity.
Yeah.
That's the problem with this. Okay. I do think it's correct though, but just that wording, double indemnity. Okay, 'cause it should be compensation, not indemnity. Yeah. Okay. Let's just check something quickly here. Personal accident. Okay. You've got that UNISA textbook, eh?
Yes.
Alright, I'm just checking that UNISA textbook just to see what they have here when it comes to personal accident. Okay, so examples of personal accident. Okay, occupation. Okay, that's fine. Okay, that's there. Okay, personal accident insurance. Let's just have a look at what they wrote here. Okay, so in your NUSA study guide, they said personal accident insurance compensates the insured for injury or death caused by violent external and visible means as a result of an accident. Okay, that's actually the same as what the textbook said. Okay, they said illness is not covered. Okay, but this wasn't an illness. Right, most insurers include a personal accident section in their domestic packages. The benefits for personal come out under capital payments for death or permanent, total, or partial disablement. Right, personal accident insurance is a policy of compensation, C, and not indemnity, since it is impossible to put a price on someone's life. The insurance can only pay compensation for the injury sustained or death. Okay, so see, they even say in their own study guide that personal accident insurance is a policy of compensation and not indemnity. So I don't know why they've used the word indemnity there. Okay, that's strange. Right, and they even say that the insurance policy can only pay for compensation for injuries or death. Is that right?
Yes, it is.
Okay. Alright, so I do think 2 is fine as it is, just the wording doesn't seem right. Okay.
Yeah, the wording is a bit off, yeah.
Yeah. Which option would you have chosen if you had to... if
I actually went for 3, and...
Why 3?
I don't know if I read somewhere in the textbook I'm trying to refer, because I went over the questions, but
okay, let's check. You're saying the textbook?
Yeah, but I wrote a page number, but it doesn't even make sense. Page 62, but there's nothing there.
Yeah, because
but it's about double indemnity, though.
Double indemnity. Okay, that's worthwhile looking at. Page 66.
It's actually page 63.
It's the textbook one, eh?
Yeah, it's a textbook.
What chapter is it under?
Chapter 3, called? the practice of underwriting. It's chapter 3.
Practice of underwriting. Okay, yeah, there's it there. Page 63. Okay, so I think it's the same page in my textbook as well. Let's have a look.
It's actually under contribution 3.2.5.
Contribution 3.2.5. 3.2.5. Okay. 3.2.5. 3.2.5. Under contribution.
Yeah. But then if you read that paragraph, option 2 is the most accurate answer.
Okay, I can't find it here. It's practice of underwriting.
Yeah, it's under contribution and it's paragraph 2.
Okay, if I look at the table of contents, which is it? Is it under insurable interest, insurable and insurable risk, proposal, procedure, premium collection?
I'll tell you now. It's under indemnity.
Under indemnity?
Yeah. Special legal characteristics of insurance contracts.
Okay, it's under indemnity. So that's okay. Let's see here. Okay, so you found contribution there. And they mentioned something about it.
Yeah.
Let's have a look. Okay, I've got betterment here. Indemnity. Okay, here's indemnity. Okay, it's under indemnity.
Yeah.
Alright, so yeah, it's actually the UNISA. This was that additional study guide that UNISA used to send the students in the past as a summary. This was on page 33. Okay, it says here, the general principle of indemnity. Okay, the insurer's liability is limited to the real or actual value of the loss suffered during the event. It cannot exceed either the amount insured or the amount of the insurable interest. And if it exceeds either or both of these amounts, it will be reduced to the smaller item. In other words, the insured cannot make a profit from his or her loss, or is sometimes said is not entitled to double indemnity. Okay, so see, you can't really profit from that, because even like, so for example, here's the scenario. If you take out life cover, but you take out life cover with 5 different insurers, but your life is only, inverted commas, worth, let's say, $1 million. Okay, will each insurer pay out $1 million?
No, they'll pay out a pro rata portion, probably.
Exactly, yes. Okay, because it avoids being paid out more than what that person is actually covered for.
Yes, true.
Yeah. All right. So double indemnity is always not considered in terms of compensation.
Okay.
Okay. So I think maybe the word they're using here is interchangeable.
Yeah, it's wrong. Yeah.
Yeah, I think they're using the word indemnity to also refer to compensation.
Yeah.
Okay, it's a possibility. Okay, but the two are quite different. Indemnity is putting someone back in the position they were before. Compensation is giving them compensation for something that has occurred.
Okay.
Yeah. Okay. That they did mention in the textbook. I think I gave a reference a bit earlier to it. Okay. Right. So let's go with 2, but just the wording is a bit problematic, but it should be fine.
Okay.
Okay. All right. Okay. Now here we've got a nice one. These risks are always popular. Hey.
Yeah.
Okay. So what is terrorism?
It's option 1.
Why do you say uninsurable? Because it's a fundamental risk. Do you agree?
Yes.
Okay. Fundamental would be something that affects
Everyone.
everybody, irrespective. Okay. Would insurers want to insure terrorism?
No.
Okay. So definitely won't be insurable. Right. Do you remember what particular and speculative are in terms of risks? Do you remember what the difference is?
Particular is when they tell you what it actually is, like theft, I think.
Okay, yeah. Particular is for a specific, let's say, insured. Okay, so the insured will have a particular risk because it affects that one individual. So, for example, if you're in a car accident, whose car is damaged?
My car.
Your car. So that's a particular risk. Okay, because it's a risk that relates to you as the driver or owner of the vehicle. Does it make sense?
Yes.
Okay, when looking at a speculative risk, there you're looking at a provision for some gain or loss. It could be either or.
Okay.
Okay, fundamental risk is things that affect everyone. Okay, so earthquakes, war, riots, famine, unemployment, recession, and so on.
Okay.
Okay, fundamental risks are also caused by social, political, or other factors.
Okay.
Okay, so if it's a pure risk is going to be something that involves loss, and if it's particular, it relates to that individual. Right, so particular, definitely not. Speculative, definitely not. Insurable, definitely not. 1 is correct. Okay, question number 4. Consideration in terms of insurance policies. Okay, that's a nice question. What do you think it is?
Option 2.
Okay, defines the conditions of a policy, is not essential for concluding a contract, refers to the terms and conditions, refers to the extension of a policy. Okay, so consideration is the payout. Do you agree?
Yes.
Okay, is not essential for concluding a contract. Yeah, consideration wouldn't have to be essential, okay, because it might not always be something that needs to be, let's say, paid in terms of a consideration. It could be other. Okay, so would a repair be consideration?
Repair, no.
Consideration would be, oh, hold on, compensation. Compensation is looking at the paying. Consideration in terms of insurance policy?
According to the textbook, it says that consideration is defined as the payment of the premium.
Yes,
of the premium.
The premium part of it. Yeah, not the payout part of it.
Not the payout.
Yes. Okay, the payout part of it would have been the compensation.
Okay.
Okay, so the payout part would have been the compensation. The consideration is actually referring to the premium.
Okay.
Right. So I was thinking about the payout, not the. I was thinking about the compensation, not the consideration. The consideration would have been the paying out of a premium. Okay.
The words can be confusing sometimes.
Yeah, it can. Yeah. So it defines the conditions, definitely not. Refers to terms and conditions, no. Refers to extensions, no. Is not essential, yes. Okay. So this is relating to the premium.
Okay.
Okay. Compensation is the payout part.
It's on page 55 of the textbook, the new textbook.
Okay, page 55 of the new textbook. Okay, great.
Yeah.
Okay, good. Let's look at question 20. Not 20. Question 5. Alright. An insurance has a motor policy with a straight deductible. Okay, so if it's a deductible, what does that mean? It's the portion that you are
going to pay.
Self-funding.
Self-funding.
Yeah, that you're going to pay. Almost like an excess.
Okay.
Okay, the insured is involved in a car accident, sustaining damages of 10. The damages will be covered in full by the insured on a relatable basis, in full by the insurer, in full by the insurer, less the deductible. Yes.
Option 4.
Yes. Okay, so deductible, fancy word for self-insurance or excess. Okay, remember you get excess in franchises? Do you remember that?
Yes, yes.
Okay. Alright, question 6. The principle of subrogation. Okay, so subrogation is when you allow your insurer to act on your behalf.
Sure.
Subrogation. Okay. Let me think about that. Yeah, that should be right. It's assumption. No, hold on a sec. Subrogation. Yeah, subrogation applies to policies of compensation. Is in force where the insured is considered underinsured. Is in force where the insured is insured by one or more. Enforces the principle of indemnity. Okay, applies to policies of compensation. I would say number 1, but let's just double check. This is subrogation. Subrogation. Let me find the definition here. Subrogation literally means to stand in place of. Okay, it is the right of one person to stand in the place of another. Okay, so remember when you're in an accident and it's not your fault, okay, who claims on your behalf?
Your insurer.
The insurer, yes. Okay, so they say here the origin and scope of subrogation are controversial. However, subrogation is a consequence of indemnity. Is that there? Enforces the principle of indemnity? No, that's almost correct. Okay, they go hand in hand. It actually might be that one then, because if we think about...
Yeah, I went with option 4.
Yeah, because applies to policies of compensation. If you're being compensated... well, that also could be a consideration because the insurer would be paying out. Oh, but that's also indemnity though. Okay, because compensation is when you're paid out a portion. Indemnity is when you're put back in the position that you were before. So if I'm looking at subrogation, it's giving someone else the rights. The principle of subrogation applies to policies of compensation, enforces the principle of indemnity. Well... 4 would probably be a better answer because you're giving the insurer rights to sue the person that was guilty. The guilty party.
Mm-hmm.
Okay, because we know that subrogation is giving someone else your rights. Okay, enforce where the insured is considered underinsured. Is enforce where the insured is insured by more than one insurer. Okay, no, yeah. Right, enforce the principle of indemnity. That would be fine. Okay, so 6 number 4 as well. Okay, number 7, indicate the correct statement. Collusion or theft by employees is a general exclusion. Okay, so here's that note about exclusions and exceptions. Okay, right, so if I'm looking at theft, okay, would theft by the employees be covered? Yes, it would be. Okay, so collusion or theft by employee, no, it wouldn't. Employees shouldn't be stealing. Okay, employees shouldn't be stealing. So if employees are stealing, okay, it'll be a general exception. It'll be an exception, not an exclusion. So that makes that wrong. Okay, that should have been an exception. Okay, because exception means what? Except.
It's not covered.
Ever covered. Do you agree?
Yes.
Okay, so an insurer will never cover theft or collusion by the employees. Right, unless you have specific insurance cover for it. Okay, for fraud and corruption. Okay, cover for property, also covered in terms of marine policy, is a standard exception. Okay, so here we're looking at marine. So if we're looking at the cover for property, also covered in terms of, okay, so the property is also covered under marine, is a standard exception to the multi-peril policy. Okay, standard exception means it will be excluded. Okay, let's keep that one in mind. Okay, let's check the others first. Exceptions to policies can be deleted. Okay, exceptions to policies cannot be deleted. So that one's out. Loss of damage arising from war is a general exclusion. Okay, that'll be seen as a general exception. Do you agree?
Yes.
Okay, that's also out. Alright, so then the right one is number 2. Correct option 2.
It's if you refer to page 173 of the textbook, it explains everything there.
Okay, perfect. 173 textbook as well.
Yeah.
Right, relating to the marine policy.
Yes.
Okay, excellent, great. Okay, but yeah, by process of elimination, we also could get the right answer just by considering that exception versus exclusion bits.
Yeah.
Okay. Alright, question 8 is finite insurance or reinsurance. Okay, so is classified as long-term insurance in the insurance market? No. Okay, we're not looking at long-term. Is an aggregate limit of cover finite? Finite would be a specific amount. Aggregate limit of cover, possibly. Okay, let's keep it. Number C, compensates the insured for limitation on risk through control procedures. Compensates the insured for limitation of risk through control procedures. Okay, and then we've got, because reinsurance would be a limitation of risk. Okay, D, takes expected investment income into consideration when calculating premiums. Takes expected investment income into account when calculating premiums. If I'm looking at premiums would be what you're collecting. Investment income would be separate. I would go with B and C here. What would you go with?
I also chose D.
Also D.
Because, yeah.
Let's check
really?
it.
Okay.
Let's look at premiums. Investment income. Let me search for investment income and see what we get.
It's in the textbook, I think, page 262.
262. What section?
It's under finite risk insurance and capital market instruments.
Okay, that'll be study
15.
guide then, actually. Hey, it's not in the textbook.
Okay, but it's in my textbook.
Okay, yeah, the one with the it would have been this thing, yes. Okay, so finite insurance.
Okay, let me just.
Finite insurance. Finite insurance. Functions of finite insurance. What topic is it under? What heading?
Characteristics.
Characteristics. Okay, so let's look for characteristics. Okay, there we go. Characteristics. Alright, aggregate limit of cover. That was fine. We saw that here, hey?
Yes.
Yes, we did. Okay, so there's the aggregate limits of cover. That's fine. Multi-year contracts, higher premiums, offset by a substantial amount of premiums in terms of lower than expected losses. Okay, let's see. Okay, that's it.
You want to look at the WhatsApp that I sent you, because in the textbook it says the expected investment income is also explicitly considered when the premium is calculated.
Okay, let's just have a look. Okay. Alright, so takes expected investment income into account when calculating premiums. Okay, then that would be, then you would include that as well. Premiums for okay, finite insurance and reinsurance. Okay, here's it here. Okay, in terms of the premiums for typical financial insurance products are higher than those conventionally, so it is being included. Okay, differs from comprehension. Okay, so yeah, so we need to include D as well. Okay, so 3 is B, C. We need to include D as well. Okay, so number 4, B, C, and D. B, C, and D. What page was that in your textbook?
Sorry?
What page was that in your textbook?
It's page 262.
262. Okay. Alright, let's have a look at number 9. Insurable interest. Okay, that's a nice question. I think this was even an assignment question.
Yes.
Yeah, so you've got that list of scenarios, okay, where you've got in terms of insurable interest. Okay, so when a marine policy is issued, at the time of a life insurance claim is submitted, when entering into a wagering agreement, when a life policy is issued. Okay, so definitely when a life policy is issued, insurable interest must exist. You can't issue an insurance policy on someone else's life if there's no insurable interest. Okay, definitely number 4. Do you agree?
Yes.
Okay.
I've got the same answer.
Number 10, indicate the correct statement. Okay, so here's that stamp duty question that you mentioned that you sent info on.
Yeah.
Okay, so stamp duties are paid on short-term insurance policies. I'll give you a chance to answer that one. Yes or no?
No, not anymore.
Not anymore. Yes. Okay. Consideration in terms of insurance policy refers to the terms and conditions of the policy. Consideration, that will be the premiums again. The replacement of stolen assets with new assets is a violation of the principle of indemnity. No, it isn't a violation of the principle of indemnity. The issuance of a policy is not essential for contract. Yeah, that's correct. 4.
Yeah.
Okay.
You can put a textbook reference from page 55 right to 57.
Okay, perfect.
It has, yeah.
Thank you. Yeah.
It covers all those 4 points.
All 4 points, great.
Yeah.
All right. Yeah, I know the stamp duty thing was something that was changed recently. Okay.
Yeah, they also sent a communication to us telling us that the stamp duty thing has changed.
Yes. Okay. So that's. I'm glad they've done that. At least then they've created awareness about it. Yeah. Because in the old past papers. Okay. So when you do refer to old past papers, the answers there would have been stamp duties are paid, but now obviously we need to change it because of the legislation.
Yeah, so there'll be no correct answers under that question.
Yeah, that's actually true. But based on the old legislation, there would be a correct answer. Based on the new legislation, there wouldn't be.
There wouldn't be.
Yeah. Okay, so not paid on policies now. Okay, do you agree?
Yes.
Okay. Hull insurance. Okay, so now I remember I had a note about this in the notes. I spoke about the hull insurance. Okay, so obviously hull insurance. If you think about a boat, the hull is going to be the actual boat. So like the what's the right word? They call it the
vessel.
Vessel. That's it. Okay, the actual boat part of the boat. If that makes sense, the vessel part.
Yeah.
Yeah. Okay, so hull insurance is only available to completed vessels covers the vessel and the associated machinery. Yeah, it would. Okay, that'll be the boat. Okay, so the boat part is the vessel and the machinery. That's the boat part of the boat. Do you agree?
Yeah. Yes.
Okay. Only covers perils or provides for cover. No. Okay, it's definitely, yeah, it's hull. Hull is easy to remember. Just think about it, the boat part of the boat.
Yeah.
Okay. Alright, question 12. Okay, a house owner's policy. Okay, if it's house owners, then it's the actual infrastructure. Okay, covers the building and outbuildings of residents, but can also be extended to include swimming pool machinery against deterioration. Okay, against deterioration, no, you can't cover wear and tear allowance. Okay, because things have wear and tear, so you can't extend it for wear and tear. Okay, deterioration is going to happen whether you like it or not.
True.
Fixed sanitary wear against chipping and scratching. Accidental damage to television sets and video cassette recorders. Fixed glass against accidental breakage. Okay, fixed glass against accidental breakage. Accidental damage to television sets and video cassettes. No, that'll be house owners. I would be going with either 2 or 4 here. Let's just check now. Fixed sanitary wear against chipping, or if it's sanitary wear, it's stuff that we're eating and using. That there will be deterioration. Those things can break. Fixed glass against accident. I would go with 4 here. Fixed glass against accidental damage.
Yeah.
Okay. Option 4. Okay, because plates do break, and that would be chipping and scratching would be the like depreciation. Okay, so the key concept here would be you can't insure. So, for example, can you insure your tires from losing its tread?
No.
No, but you can insure your tires for hitting a pothole.
Yes.
Okay, pothole damage versus wear and tear. Okay, did you also go with 4?
Yes.
Okay, good. Question 13. An insurer has a stop-loss treaty of 90%. Okay, here's that stop-loss treaty bit. Okay, so 90% of any excess of claims over 70% of premiums in 1 year up to 100. The insurer has 20 million premium income and loss amounting to 18. Stop-loss treaty will pay. Okay, so we need to do a calculation here. Alright, so 70% of premiums is the first thing that we need to work out. Okay, so 70% times 20 million. How many zeros? One more. 20 million. Okay, gives you 14 million. Alright, so 14 million is the 70% of premiums. Okay, the losses were 18 million. Right, so an insurer has a stop-loss treaty for 90% of any, it should be excess of claims over 70% of the premiums. Okay, so what is the excess? The excess is 18 minus 14. 4 million. Times 90%. Option 4.
Correct.
Got that as well?
Yeah.
Good. Happy that one?
Yes.
Okay, 14. You insured your house with a newly founded insurer in order to limit its exposure. The insurer enters into reinsurance agreement in terms of which the reinsurance company retains. Okay, so the reinsurer is keeping 70 of the total risk. The insurer retains 30. Okay, this reinsurance agreement is known as, this would be a quota share treaty because they're each going to be taking a specific portion. Alright, so quota because it's half, well, it's not half, it's 30-70. Okay, it's not a excess of loss surplus treaty, it'll be a quota share, a specific amount is being taken. Do you agree?
Yes.
Great. Okay, that's just theory. Okay, 15. Indicate which of the following will be covered under all risk. Okay, that's nice. All risk. Torn evening jacket. No. Okay, because the evening jacket can be torn. It can be, well, that's part of wear and tear. Okay, an expensive cricket bag stolen from a locker room at school. That would be because you weren't using the cricket bat to play cricket. A crashed computer hard drive? No. Money,
No.
checks or coins? No, that's something separate. Okay, so an expensive cricket bag stolen from a locker room? Definitely.
Mm-hmm.
Okay, if the cricket bat was used in the field, it wouldn't be. Okay, all risk covered, it would be covered. Okay, do you agree?
Okay. Yes.
16. In terms of the difference based of accounting the annual gross profit under business interruption insurance, gross profit is defined as. Okay, so business interruption insurance is when the business is going to be suffering a loss because they can't operate due to a risk event. Okay, the difference basis of calculating annual gross profit. Okay, so net profit plus standing charges, turnover minus closing stock plus opening stock and uninsured costs, turnover plus closing stock, net profit less standing charges. Okay, this is a very specific question.
Yes.
First time I see this type of question, I'm just going to quickly refer to business insurance to see if we can get a more specific answer.
It's under commercial insurance.
Under commercial?
If you're looking at the tech insurance.
Okay, let's see. Commercial insurance.
On the new textbook, it's under page 178. It will be under business interruption insurance.
Alright, let's double check. Okay, so commercial insurance, I've got that. That's on page 144 in this one. Okay, so let's just go there quickly. Okay. I've got business interruption insurance here, yes. And we look at the mathematics of
it will be under gross profit. Yeah.
Yes. Okay, there's it there, yes. Okay, so gross profit. Okay, the insured needs to work out his annual profit. The profit clearly defines gross profit. If there are two bases that can be there's two bases that can be applied.
Yes.
The one is the difference basis and the other is the additions basis. Here, what basis are we looking at? The difference basis.
Difference basis.
Yeah, so turnover plus closing stock less opening stock and uninsured costs. Right, so that'll be option number
3.
It's plus closing stock, yes. Option 3, not minus. Okay, so that was page. New textbook is page 1, 2,
178.
178. Okay, new, old is on 150. Okay. All right. Question 17. Indicate the correct statement. Okay, so here's Fidelity Guarantee Insurance provides cover against theft or of money and stock by employees. Yeah, fidelity, remember we think about infidelity. Infidelity means it's ethics, unethical, moral. So that's the employees doing something bad. Do you agree?
Yes.
Okay, so Fidelity Guarantee Insurance is always issued on a named person basis. The premium Fidelity Insurance is based on the sum insured number of employees. The level of hazard under Fidelity Insurance is judged by salaries and wages. Okay, Fidelity Insurance Guarantee provides cover. Definitely the first one.
Yes.
Okay. I think I've seen this question before, though. It looks familiar. I think they like Fidelity Guarantee Insurance. So it would be a good idea to go over the consideration there, because sometimes they're going to change it slightly.
Yes.
Fidelity Guarantee Insurance is based on 3 bases. Okay, bases, it's the named person's basis. Okay, is it always issued? Not always. There are 2 other bases. There's a positions basis and a blanket basis.
Blanket basis, yeah.
Okay, so that one's out. It's not always on that basis. Okay, and then based on the sum insured number of employees, it's number of employees, sum assured, and the level of controls. Okay, so that one's also out. It's missing level of controls. Okay, but yeah, the first one is correct, definitely. Just think infidelity. That's how I remember it. Okay, infidelity, so lack of morals. Okay, fidelity, infidelity, it'll be theft or of money or stock by the employees.
Okay.
Oh, but hold on, Melanie. Fidelity Guarantee Assurance, it does not cover theft of money only, but also theft of... Oh, it does cover all 3. That's fine. No, it's correct. Sorry, I'm just reading it funny. Okay, it's correct. Okay, so if you read it, it doesn't only cover money, but also theft and stock.
Yeah.
Alright, that's how I should have interpreted. Okay. Alright, so yeah, so definitely 1. Right, 18. Indicate the correct. Okay, arbitration can be used to resolve all types of claim disputes. Litigation can only be used to resolve problems of quantum. Okay, quantum is when you're arguing about the amount. Okay, litigation can only be used. No. Negotiation is the most common way of handling dispute claims. Negotiation, no. Arbitration are normally conducted in a court of law. No. Arbitration can be used to resolve all types of claim disputes. I would go with, negotiation is the most common way. I would go with 1 here because arbitration would be able to resolve disputes. I know quantum, they're quite specific here in the textbook. Let me find that page reference. Arbitration is when you get someone external, arbitration, to argue, or not to argue, but to listen on the dispute. Okay, so would you be able to use arbitration as a remedy for all claim disputes? Yes, definitely. Litigation can only be used to resolve problems of quantum. Okay, quantum is when you're arguing about the amount. Litigation, quantum. Let's check. Litigation. Okay, claims disputes. Alright, here, negotiation though. Let's just see if they've given a specific note here about negotiation. Alright,
I went for negotiation because...
Did you go with negotiation?
Yeah.
Okay.
Because the textbook says negotiation is the most common way of handling disputed claims.
Okay, yeah, chapter 6. Okay, so you've got that page reference. What's in
it's
your
page
textbook?
128.
128. Okay,
Yeah.
in this
128 one.
Let's check it. No claims after tax disputes. Okay, here's the disputes. Okay, here's litigation. Okay, litigation is costly. The quantum, though, arbitration is a process whereby independent parties. Arbitration can only be used to resolve problems of quantum, right? Which is the amount of the settlement. Okay, that was wrong. Okay, I was thinking about arbitration solving everything. It wasn't that. So arbitration should have gone with that, the quantum. Okay, that was the problem. Sorry, wrong point there. Arbitration is only for quantum problems.
You must write that under question 18.
18. Oh yes.
Yeah.
Okay, move it down. Okay, question 17, question 18. Okay, 18's answer then 3, negotiation. Let's see here.
Yes.
Negotiation. Oh, yes. Okay, so here under this heading, negotiation is the most common way of handling dispute claims. This process will normally involve the broker, the insured, or the insurer. Discussions are held until an amicable agreement is being reached. Okay, so negotiation was the right answer there. Okay, so arbitration only for quantum. Negotiation, most common way of resolving claims. Okay, I think maybe if you don't overthink it too much, how do people normally solve their problems? It is by discussing it.
Yes.
Okay, talking about the problem. Communication is the best way to solve a problem, and negotiation would be referring to that when dealing with policies.
Yes.
Okay, so maybe just to keep it simple, yeah. Okay. Right, question 19. With regard to a comprehensive motor insurance policy, indicate which of the following statements are correct. The cost of hiring a vehicle after an accident will normally be covered by the policy. Tire damaged by the application of brakes will be covered. No, never. Tire damage won't be. The insured is generally not covered by the policy. He or she be involved in an accident while driving a car not belonging to him or her. The insured is generally not covered by a policy should he or she be involved in an accident while driving a car not belonging to him or her. The insured is generally not covered by the policy should his or her vehicle be driven by an unlicensed driver. Okay, unlicensed driver, right, in terms of the insured is generally not covered under the policy. If it's an unlicensed driver, that would be correct.
Yes.
Okay, the cost of hiring a vehicle after an accident. The cost of hiring a vehicle after an accident will normally be covered by the policy. It could be. Sometimes insurers will provide you with the vehicle and pay for that. So yes. C. Let's check C again. The insured is generally not covered. So the insured is the person with the insurance policy, not covered by the policy should he or she be involved in an accident while driving a car not belonging. Yeah, so if you're driving someone else's vehicle and you crash that person's vehicle, that wouldn't be covered.
No.
Okay, definitely not. Okay, so C, A, C, D. A, C, D is what option? Okay, 4. We have an
4.
option. Okay, good. Alright, the last multiple choice, the major limit of money of a money policy applies to money. The major limit of a money policy applies to money transferred to and from the bank, held at the home of any partner director, held in custody of directors on the business, stolen by employees. This is very specific. If I remember correctly, we'll check it, but I think it would be money policy held at the home of any partner or director, held in custody of directors on business of the insured. No. Stolen by employees, the money limit, the major. It related to the safe, so I would think it'll be what's at the actual place, so it'll be at the home. Money insurance. Let's just see though.
I went with option 1, page 184 of the textbook. It's under commercial insurance.
Money insurance. Okay, the major limit. Okay, I see the page reference here. Okay, so chapter 9. Let's just double check. Okay, chapter 9, money insurance. Fidelity Glass, money insurance. Okay, the intention of this cover is to identify the insured for money loss or damage whilst at the insured's premises, being transported to or from the bank. Okay, so held at the home. Okay, that wouldn't be right because home isn't the place of business. Yeah, so it was business that I was looking for. That was not the home of the partner or director. So then, one would be the other option because it's either at the insured's premises. So insured's premises, or to or from the bank.
You must put that under question 20.
Yes, sorry. Okay. That's right. Next question, last question 20. What page was that in your textbook?
184.
Okay, 184. And then in the old, 156. Okay, great. Alright, that was option number 1. Okay, good. Alright, you seem to be very good at your risk, Melanie. You're putting a lot of thought into, which is good. Okay, nice. Alright, so let's see how section B goes. Okay, this is true and false. This won't be so bad because it's we will have to look at references. So I'll try to give you references for each of them. Okay, let's first go with the first one. Okay, so an insurance system can only operate successfully when potential loss can be predicted accurately. We need to measure it, so that would definitely be true because that's insurable risk. Okay, so insurable risk must be measurable. Okay, the loss needs to be measured or determined. Okay, so an insurance system can only operate successfully when potential losses can be predicted accurately. Okay, the losses. Okay, so here they're referring to the actual losses in terms of pooling. So the probability is something to consider. So you could also maybe motivate that the law of probability. Okay, so when we have probability of an event occurring. So an insurance company can only operate successfully when potential losses can be predicted accurately. Right, it wouldn't always be predicted accurately. An insurance system can only operate successfully when potential losses can be predicted accurately. Okay, it wouldn't only be predicted accurately as long as there's room for predicting it. Okay, so if I look at these two, so insurable risk must be measured, that was 1 point. Loss needs to be determined. Law of probability would apply here. Okay, so if I say true or false here, an insurance system can only operate successfully when potential losses can be predicted accurately. Okay, it wouldn't be okay, so not only successful, right? Because if it's predicted accurately, that means we're going to know exactly what's going to happen. Okay. Right, so that will be false. It'll be based on pooling risks that have a probability probability of occurring. Okay, so the word only there would be what I would focus on as making this false. So an insurance system can only operate successfully. It cannot only operate successfully when potential losses can be predicted. Okay, so obviously, can you predict losses?
No.
No, but we're pooling similar losses together.
Mm-hmm.
Do you agree?
Yes.
Okay, would you also agree with false then?
No, I actually didn't answer that question.
Oh, okay, you haven't answered it. Okay, because I would go with false here because it's based on pooling those risks together. Okay, let's see if we can find a reference here just to see what the textbook gives us. I'm just going to search quickly. Insurance system. Let's see. Okay, so here, what is insurance? From a financial product point of view, an insurance system accomplishes the redistribution of the cost of losses by collecting a premium from every participant in the system. In exchange for a payment of the premium, the insurance system promises to pay the insured compensation in the event of a loss. In most insurance systems, only a percentage of those insured suffer a loss. Okay, so that's see, it's the rate. It's relating to the pooling here as well. Yeah, see, these are paid in the funds of pools. Each premium is split between the pool. Yeah. Okay, so an insurance system can only operate if you can predict things accurately. You can't predict things accurately. It's left up to a percentage of.
Okay.
Okay, so I'm not too sure if you'll have that in your textbook. Probably. What is insurance? It's under that chapter. See, that was the paragraph I was reading.
Oh, okay. I'll go and look for it.
Okay, what is insurance would be the right chapter for that. Okay, what is insurance? Okay, so this is so I emailed you the emailed document. Okay, it's on page 11 of that document. Okay, they talk about the pooling here. They talk about the policies. They talk about the payrolls. Okay, so question 1.1 says an insurance system can only operate successfully when potential losses can be predicted accurately. Well, we know we have to measure those losses, but that's not the measurement of the losses. Here they're looking at predicting the losses. Can we predict the losses?
No, we cannot.
It's based on probability. Okay, so it's a portion of. Okay. Alright, question 1.2. A farmer issues his crop for 80,000. The value of the crop is 120. A loss of 50 is sustained. If the principle of special condition applies, 33 will be payable by the insurer. Okay, so do you agree? This is looking at underinsurance.
Yes.
Okay, in a normal scenario, if the special condition doesn't apply, this guy is only going to get a portion of his crop. Do you agree?
Yes.
Okay, so damages, how much was the damage? Okay, so loss of 50,000 times 80,000 over 120,000. Alright, so that's how much he would get paid out if he was underinsured. Do you agree?
Yes.
Okay, so he would only get paid 33,300. Okay, but here it said if the principle of special condition applies. Okay, so we know the 33,000 is correct, but here they're talking about special condition. Okay, so we need to check the special condition. Okay, alright, in the case of a 75 condition, okay, special condition of average. Alright, so this is on page 58. Okay, so they talk about special condition. Right, in the case of a 75 condition of average is applied, okay, example to agriculture produce. See, it does apply to agriculture. The insured will share in the loss only if the sum insured is less than the stated percentage of 75%. A similar form of average applies to reinstatement insurance. Okay, so is this 75%? Let's check. What is 75% of what's the crop worth? 120,000. Um, 90,000. Okay, the farmer insures his crop. He has insurance for 80,000. Okay, so in this case he is less than the 90,000, which is the 75% special condition. Okay, so just to recap that, okay, again, just to give you a page reference, this is on page 58.
Okay.
Page 58 of the emailed summary notes. Summary of the emailed file. Okay. That was what Eunice gave you. I think that would have been part of your textbook. It's under methods of settling claims.
Okay.
It's under, let me check what chapter this is, and then just check the chapter in your book. It's on chapter, study unit 7, claims procedures.
Claims procedures.
Yeah, claims procedures. And then there's a note here about the indemnity, and then they talk about the special condition here. Special condition of average. So, in this case, 75% condition of average is applied. The insured will share in the loss only if the insured claim is less than the stated percentage of the value at the time of the loss. The average does apply. It is the pro rata condition applies. A similar form of average applies in reinstatement insurance. Okay, so 75 position example to agriculture produce on farms. That's what they even said. So this is agriculture. Yeah, this guy's a farmer. Okay, so the insured will share in the loss only if the insured sum is less than the stated percentage of 75% of the value insured, which is indemnity.
Okay.
Okay, let's also check. Let's just see what else we get here. Okay, here's even an example here, Melanie. They might even give you an example as well. The example on page 50, on page 60. They spoke about here. I'm gonna read the example out and we'll discuss it. Okay, let me show the picture. Here's the picture. Okay, a crop is insured for 75. The whole value of the crop is 100,000. The crop is damaged. Crop damage amounting to 20 occurs. Which amount will the insurer pay out of the special condition if average applies? See, there's the special condition thing. Okay, so the crop will be 20,000. 20,000 is the full amount. Okay, because what is 75? What is 75% of 100,000?
75,000.
75,000 is the crop insured for 75,000.
Yes.
Yes, so the insurer will pay the full 20.
Mm-hmm.
Okay, in our example here, okay, in our question, how much is 75% of the crop? 90,000. How much did you insure it for?
80,000.
80,000. So is the insurer going to pay out the full 50? No.
No.
They're only going to pay the 33. Okay, so is this true? If the business condition applies to 33, will be paid by the insurer. True. Insurer only pays a portion. Okay, happy with that?
Yes.
Alright. Number 1.3. An insured insured his vehicle on two different insurance companies for its full value. Okay, this is obviously contribution. Okay, in the case of a loss, he would therefore be sufficiently insured as well as be able to profit? No, never. He'll never be able to profit. False.
No.
Okay. You cannot profit from having multiple insurance contracts or policies on the same asset. Okay, the principle of contribution would apply. Contribution, okay, only a portion will be paid out by each insurer. Do you agree?
Yes.
Okay, because contribution is when they're going to split it, because there's only a portion of the loss that each needs to pay for. Okay, the principle of contribution, I just want to find contribution. Okay, there's it. Alright, it's on page 38 of the emailed file that I sent through to you. Okay, so page 38 of the emailed file. Okay, they talk about the principle of contribution there. Okay, it's probably on a different page, but remember what UNISA used to send to their students, okay, is now what's in your textbook that you had to purchase from the institute.
Okay.
Okay. Alright, it's definitely, I didn't write false or true. It is definitely false. Okay, just to put the answer there. Right, 1.4, the suicide clause included in life policy reduces adverse selection in terms of life insurance. Okay, the suicide clause is when it's a payout. The suicide clause is seen as an an exclusion. Suicide clause. Where is it writing? Oh, no wonder. Suicide clause. Okay, no payouts. Okay, it's a suicide clause. Right, let me find a note about that here. Suicide clause. Okay, alright, the suicide clause states that no claim will be admitted if suicide is committed within 24 months of the date of the letter stating that the policy has been accepted or reinstated. Policies that are reinstated without proof of good health will be subject to the suicide clause, only to the extent to which the original 24 months will apply. Policies that are reinstated, okay, sorry, I read it funny because of the way that it was written here. Okay, they didn't put the what do they call it? The dash. Okay. Reinstated. Okay, with proof of good health are again made subject to the suicide clause from the date of reinstatement. Whether the policy will respond to the claim therefore depends on the specific circumstances surrounding the reinstatement. Okay, but the suicide clause, it's as far as I remember, it was let me just double check before I mention it. Come on, suicide clause. Aha, there's it. Okay, adverse selection. Some insurance policy provisions are designed to reduce adverse selection. For example, the suicide clause in life insurance contracts avoid liability to an applicant who purchased life insurance because he or she is contemplating taking her own life. Okay, so that is part of the adverse selection. Okay, so if I look at this, suicide clause, no payout. Let's see what they said. Suicide clause included in life policies reduces adverse selection in terms of life insurance. That would be true. Okay, because it prevents no payouts. Okay, it's an exception.
Okay.
Okay, so true. It's page 14 of the file. Okay, so we know it's something that's excluded from the payout. Do you agree?
Yes.
Okay, it's an exclusion whereby the policy holder won't be allowed to claim. Okay, there's going to be no payout if you commit suicide. Right, so in terms of adverse selection, it would prevent people from committing suicide to take out life insurance. Do you agree?
Yes.
Okay, so if we were a bit loony, okay, and if we were committing suicide, okay, we would go take out life insurance and then commit suicide, and then someone will get paid out. Do you see?
Yeah.
It's going to prevent all those crazy people from taking out life cover. Adverse selection. Does the insurer want crazy people on their books?
Obviously not.
No. Okay. So number 4 is obviously true. Okay. Right. I'm just trying to cover a bit more as well. That's why we're discussing it. Just as some revision as well. Just so we cover more content. So it's not just like true or false and then we move on. Okay. Alright, 1.5, Melanie. A high claims reserve of an insurer is preferred by investors. A high claims reserve. Would investors want a high claims reserve? No, they wouldn't.
No.
Investors want profits. They want a low claims reserve.
Yes.
Okay. Why do they want a low claims reserve? Because that money can yield a return on investment. Okay, this would have been covered under the reserve requirements. Let me just find that for you. What page reference? Claims reserve. There's it. Okay, it was covered in chapter. Oh, it was the note at the end. The chapter's at the end of the book, Melanie. Okay,
yes.
It's there.
I remember seeing this somewhere. Yeah.
Yes, claims reserve. Was it this, Melanie? Did you see that? Page 99.
You don't. Okay. Yes.
That's the one, eh? You probably remember reading that.
Yeah.
Okay, page 99. Okay, so additional reference. Okay. There's another one. 1.6. True and false. In terms of the pillion passenger extension liability cover, okay, is provided for injuries to passengers carried on a sidecar over motorcycle. Okay, so this is a very specific note relating to the motorcycle. Okay, so question, does the motorcycle cover normally cover that little sidecar?
It covers the cycle under the pillion passenger extension, but it doesn't cover the passenger.
Okay, so
it's only if you take an extended policy.
Yes, okay, so normal cover doesn't cover it. Do you agree?
No, yes.
You need to extend it. So do you agree with the statement?
It's false.
Okay, why? Because here they're talking about provided for injuries to the passengers.
Yes.
Okay, injuries are not covered.
Yeah.
Injuries to the passengers. Okay. Great. 1.7. Okay, so an insured has a policy with a 10,000 deductible and a recapture factor. Should a loss of 10,000 be sustained, the insured will pay the full deductible of. Okay, so this is a calculation. We need to use that formula that you had in the notes to do this calculation. So I'm just going to find the formula quickly. Recapture. Okay, here's the formula. I'm going to take the formula and then we can discuss the calculation.
Okay.
Okay, so here's the formula. Copy paste. Alright, the formula is P equals L minus D times 1 plus R. Okay, so they want to know what? The loss. Okay, so the payment. Okay, so P equals, open brackets, L is the loss. What was the sustained loss? 100,000. Minus, what was the deductible? 10,000. Close brackets times, open brackets 1 minus the recapture factor of 0.04. Okay, so equals this equals 86,400. Okay, so what was the loss? The loss was an insured for a policy with a 10,000 deductible and a recapture factor of 4%. Okay. Plus, not minus. Sorry, no wonder. Plus, not minus. Sorry, I had minus there. I don't know why. Plus, typo. Okay, that's better. Okay, 93,600. Okay, because now what's the difference? 100,000 minus 93,600 is 6,400. Okay, so should a loss of 100,000 be sustained, okay, the insured will pay the full deductible of, okay, so an insured has a policy with a 10,000 deductible and a recapture factor. Okay, so do you agree the insured will have to pay the 10,000, but then the next claim the deductible would have been reduced?
Yes.
Okay, does that make sense?
Yes.
Okay, so based on this claim now, 10,000 is deductible. Okay, the next deductible will be 6,400. Does that make sense?
Yes.
Okay, so payment by the insurer, okay, where P is the payment by the insurer, okay, L is the loss. Alright, so what did they say here? The insured will pay the full deductible. They'll pay, it's false. How much are they going to pay? $10,000.
Yes.
Okay, that was the insured deductible, and the recapture factor was 4%. Okay, does that make sense?
Yes.
Okay. Happy with that one?
Yes, thank you.
Okay. Let's just check. Number 8. Okay, I just want to check the wording here. Payment by the insurer. What did the notes say? Were my notes wrong? We did this in the last week. Let's just check that. Did I write insurer or insured here? Okay, not rem to captive. It's the other one. There's it. No. There's it. Okay, P is the insurer's payment. Okay, yeah, insurer's payment. Okay, so P is the insurer's payment. So what did I work out here? I worked out the insurer's payment. Let's just check. The insurer's payment, 93,600. This is the insurer's payment. Okay, and that was a 9% recapture factor. Okay, so just to reinterpret that, they said here an insured has a policy with a 10,000 deductible, recapture factor of 4. Should a loss of 100,000 be sustained, the insured will pay the full deductible. The insured, the payment by the insurer, but that would have been the next payment, not the current payment. Okay, let me just show you this, Melanie. Okay, if you look at this example. Okay, have a look at this example. Okay, consider a policy with a 5,000 deductible and a recapture factor of 4%. All losses under 5,000 are absorbed by the insured. Okay, so what would the insurer pay for a 45,000 Rand loss? Okay, so do you agree, if I put 45,000 minus 5, Okay, times 1 minus gives you 41,600. In essence, the deductible has been reduced from 5 to only 3,400, which is 4,500 less 41,600. Okay, so what does the insurer pay for a loss of 45? Here we have, for a loss of 45, the insurer would pay 41,600. So the deductible has been reduced. Okay, alright, so I mentioned that the first amount that you would have to pay was 10,000. Okay, but here we're looking at a loss with a recapture factor. So then the answer would be true then. Let's double check. In this question, the recapture factor was 4%. Okay, so we worked out the insurer. So the insurer is going to pay, that's the insurer's payment, which we had. 6,400 is the reduced factor, reduced deductible. Okay, so what did I have here? Based on the claim now, 10,000 is deductible. Okay, but using a recapture factor. Okay, so the deductible will be 6,400. What is the insured going to pay? 6,400. So that will actually be true, not false. I'm going to change that. Okay, it needs to be true, not false, based on that example. Okay, because it's the same as what we had in the textbook, right, and the study guide. Right, in the study guide they refer to a 5,000 deductible with the recapture factor. Okay, so the insured pays the difference. For a loss of 45, the insurer would pay the difference. Okay, yeah, so we need to change that. It's actually true then. The insured has a policy. Should a loss of 10,000 be sustained, the insurer will pay the deductible of 6,400. It's actually true.
Okay.
Okay, sorry, that's a mistake. Okay, that's actually true now. Okay, based on what we looked at there. Okay. Alright, number 8. Underwriters request underwriter type manufacturer. The sum insured of a fire and loss of profits. Okay, the underwriter has a net line of 5 million. Okay, take additional 50% risk. Underwriter has an 8-line surplus. Okay, so 8-line will be 5 million. 5 million plus 5 million times 8. 5 million times 8 is 40 million, so it's 45 million. Okay, add 50%. What is the other bit? The fire. Fire and loss of profit, it's both. Okay, so 50% loss of profit. So 50% of 60 million. Okay, 50% of 60 million is 30 million. So they'll have 75 million. What did they say here? The underwriter has a net line of 5. What was the loss? The loss was 65. 75. Hold on a sec. What did I have here? Okay, the underwriter has a net line of 5 million and can take an additional 50% of the risk. Risk involves fire and loss. Okay, so fire and loss. 50% of fire and loss. Okay, so 50% fire and loss. Okay, so 50% of that is 60 million, 50 is 30. Yeah, that's right. And then 5 plus 5 times 8 is 45. 45 plus 30 is 75. Okay, so if we have a loss of 60, will there be facultative? No, there wouldn't. The underwriter will need no facultative insurance. That's true. The full amount would be covered. Okay, 60 million rand loss would be covered because there's an 8-line treaty. 45 million is the 8-line. 5 times 8 is 40 plus 5 is 45. plus 50% of the loss and fire. Yes. Okay, true. No facultative insurance. Facultative is when it's not enough. Do you agree?
Yes.
Okay. Alright, number 9. Mr. Smith is a plumber. Apart from the working tools he carries with him, he also carries wires and pipes and in many cases sanitary ware that needs to be installed at client's premises. In terms of goods in transit insurance, the working tools, pipes, wire and sanitary that needs to be installed will be covered. No, it won't. Tools need to be covered under what?
All business insurance, something like that.
Business all risks, yes.
Yeah.
Business all risks needed for the tools. Okay, GIT insurance. GIT only covers the materials.
Yes.
Okay, is that right?
Yes.
Okay, 1.10. Okay, Mr. Nell provides, pays the premium on his short-term policy every month to his broker. Mr. Hugo experienced a cash flow problem in March and failed to pay over the premium to the insurer before the agreed payment date of 1st April. On 10 April, Mr. Nell was involved in an accident. Mr. Nell will therefore not be covered and will need to claim the money from the broker. That's false. He will be covered. Okay. He will be covered because how many days does he have, Grace? It's in the textbook. It's in the notes.
Yeah, I've seen it somewhere. I know. I've got it written down somewhere.
Yeah, 15 days. 15 days grace period. Let's check that. Premium. Did you find it?
No.
It should be in the notes. I think, let me open the notes. I can't find anything here in the textbook. I'm searching for, let's just check here. Anything else coming up? Yeah, I just want to double check if it's 15 days. I think it's 15 or 30 days. It's one of the two.
Yeah, it's one of the two.
I think it's 15 though when you haven't paid. 15 or 30. Let's see. Where is that note? Where are you? Okay, it's in the practice of underwriting chapter.
It's chapter 3.
Yes, chapter 3.
Yeah.
Got it. Okay. It's on page 63 in the old. And in yours?
It's actually from page 87 right till 89.
Okay, 87 in the new. Great. Okay, yeah. So it says there. It says, if the policy holder is the natural person, the insured must be allowed at least 15 days grace for the payment of renewal premiums.
Yeah.
Okay, so Mr. Nell will therefore not be covered. That's false. He will be covered. He's got 15 days. Do you agree?
Yes.
15 days grace. Okay, great. And that covered that. Alright, so they're starting with question 2 here. So I'm just going to write that down. Okay.
Okay. Maybe they made a mistake.
Possibly. I think it's just numbering, I guess.
Mm.
Yeah. Okay, so this section comprises of 6 questions. They must be answered. Do we have 6 questions here, or is it just 5 then?
It's 6.
It is 6. Okay, so it's
Yeah.
2 to 7.
Yeah, and if you look at the front page, when it says section C, they do start with question 2, 3, 4, 5, 6,
Okay,
7.
that's perfect then, yeah. Okay, so
Yeah.
maybe section 1 or section B was being referred to as question 1.
Okay.
Okay. Highlight and briefly explain the 5 prescription periods in force in terms of insurance claims. That came from prescription period, chapter 6.
Yeah, it's on page 130 of the new textbook.
Yes, okay, 130, page 130 new, page 106 old.
Okay, you haven't shared your screen as yet.
Oh, sorry.
It's fine.
Okay, the screen. Okay, there we go.
Okay.
Okay.
Yeah.
Right, so briefly describe what are the 5 sections then?
It's notification,
Good.
final submission of claim,
Yes.
legal proceedings, recovery from third parties, and government claims.
Perfect. Those are the 5. Okay,
Yeah.
so it's literally they just said what? Highlight and briefly explain. This was for
Yeah.
5 marks. So it's
Yeah.
probably half a mark for knowing what it is and half a mark just for explaining it.
Yeah.
Okay, so not a very difficult question there. It's
No,
a
it's
short
not.
one, 5 marks. Number 3, let's look at that one. Question 3. Briefly highlight the role and function of brokers. Okay, that's also an easy one. Brokers came up in the first chapter where we looked at the different role players.
Yes.
Okay, so,
It's on page 32 of the textbook, the new textbook.
okay, great. All right, yeah. You can also refer to intermediaries and brokers in chapter 7 as well.
Oh, okay.
There could be 2 references here. Okay, so you had page 37, new
32.
textbook.
32.
32, sorry, not 37, 32. 32, okay, and let me just put a chapter reference here. So, brokers, the actual heading or chapter, okay, yeah, it's chapter 3, reinsurers, the risk adjusters, the regulators, and then there was a note about the brokers or the intermediaries. Okay. Okay, the broker here is on page 8 in the old page 8 old.
Okay.
Okay, so here they said briefly highlight the role and function of the broker. Okay, this was 5 marks. So what are you going to discuss? Well, obviously you're going to probably define what how a broker is different to a agent. Do you agree?
Yes.
Okay, so that's something that you could consider. The broker can do what?
They are considered to be professional insurance practitioners.
What can they sell? Can they sell other types of products?
Yes, they can.
A broker?
Broker. Is it an agent?
Okay, remember
I
the
think so.
agent? Yeah, the agent was able to sell other types
Yeah.
of products. Okay, so in the short-term market, an insurance agent is someone who would sell insurance, but broader insurance. So they wouldn't only sell a specific type of insurance. A broker would be more someone that will be tied to a specific organization.
Okay.
Okay, so brokers generally earn a commission for bringing in new business for that particular organization. Okay, so
Okay.
let's see, what else could we discuss? Let's have a look. Okay, so in the textbook they talk about brokers as being intermediaries. They normally have an agency agreement with many insurers. Okay, brokers are considered to be professional practitioners. Okay, so you had that. Legally liable for advice. Okay, that's important. The legal liability in terms of advice. Okay. Other important bits would have been the commission. Maybe you could mention something like that. The
Also,
commission,
they're responsible for collection of premiums.
yes, the collection of premiums. Premium collection. Okay, so do you agree a broker could be actually bigger than an individual? A broker doesn't necessarily have to be an individual. An individual can be referred to as a broker. Okay, but the broker could also be a larger organization. Alright, so a broker could be the business that acts as the middle person.
Okay.
Okay, does that make sense?
Yes.
Okay, and then the agent could also refer to, well, the agent would be mainly specific to the actual person.
Okay.
Yeah, so both could be, so broker could be used interchangeably between the actual business that's acting as the middle person, as the broker, or the actual individual could be the broker, depending on how big the company is. Okay. That one alright?
Yes.
Next question. A collective policy is an option available to insurer where the size of the exposure to be underwritten is beyond its capacity. Outline the basic features of a collective policy. Okay, so collective policy, again, that covers, that's under the policies. Okay, collective policy. It's almost like multi-peril if you think about it.
Yeah.
Think multi-peril. Okay, so what is it? Collective policy. Okay, the collective policy was covered. Which of the companies share collective policy?
In the new textbook, do you know where they ask you questions and answers?
Yeah,
they've got a nice explanation under page 278.
Okay, so it's the same. Does it look like this?
It's like in point form.
1.5. The appendix.
Yeah, it's something like that.
Okay, you've got it there as well.
Yeah.
Okay,
they've got
policy.
you explain the features of a collective policy, and they give you 1, 2, 3, 4, 5, 6, 7 points.
Okay, these are the features.
Yeah.
Okay, so how many do they want here? Okay, they probably want all of them, but I don't think so because this was out of 5 marks.
Yeah, so I think 5 should be fine.
Should be fine, yeah. Probably 5 of the 7 points. Okay, right. So collective policy. Which of the 5 would you think are the easiest to remember?
Okay. Each insurer has a share of the risk.
Okay, it's collective, so that's easy to remember.
The lead insurer insures the policy.
Yeah, lead insurer. You could discuss the role. Okay, the roles.
The policy reflects each insurer's share.
Yeah, share of risk.
Yeah. The claims are handled by the lead insurer. The other insurers normally follow the lead.
Okay, yeah. We're talking about the lead insurers quite a bit. What about the other points?
Okay, a collective insurer cannot quote against the lead.
Yes, okay, so no quotes against the lead.
And the lead insurer receives a handling fee from the other insurers who share the risk.
Okay, a handling fee. Okay, yeah, great. So just try to find ones that are a bit easier to remember.
Easy to remember, yes.
I must say the risk is not the nicest of subjects because there's such a lot of detail you have to remember.
Yes,
it's hectic,
true.
Yeah. Okay, so the best thing is to try use the past papers because at least you can see what they're focusing on. Just as a guide, try to help limit the scope slightly.
Okay.
Okay. Let's look at number 5. Also 5 marks as well. Okay. An organization will be engaged in a unique venture for the next 2 years. The risks associated with the venture are not considered to be insurable by the private insurance market. The insurance manager of the company suggests the company joins a rent-a-captive. Okay, so last week we spoke about a rent-a-captive. Remember, it's formalizing self-insurance, where you've got a separate legal entity, and renting a captive means you're using someone else's captive because they're very expensive to create.
Okay, yes.
Do you agree? Remember that?
Yes.
Okay, so indicate whether you agree with the suggestion and give reasons for your answer. Definitely. And then you would refer to the rent-a-captive chapter, which I will find for you in this book. Let's check it. Rent-a-captive. Okay, rent-a-captive is on page 112 and 113.
Page 112 and 113.
Okay, in the emailed set of notes that I gave you, 112, rent-a-captive, let's just find that heading. Okay, and it should be identical in your textbook as well, because they've now included this in the actual book. Before they used to send this to the students. Yeah, so study unit 16, rent-a-captive. What is a captive? How do captives work? Reasons for establishing a captive. That is what you'd be looking at. Okay, the reasons why you'd want to establish a captive.
Okay.
They said indicate whether you agree with the statement and give motivation to your answers. Yeah, so I would explain why a captive is a good consideration. You might also want to consider the feasibility in terms of, would the company be able to afford this? Okay, if the company can't afford it, must they rent a captive? If they want to use a captive, they'd have to.
Yeah.
Okay, so affordability of creating a captive versus renting one. Renting a captive. Okay, so in the textbook, there's feasibility that's covered on page 116. I think personally, the features, the reasons why we would establish a captive would be more important, and the reasons why we would use it.
Okay.
Yeah, so I think that'll be slightly more important from a test point of view if you're looking at points to write down here for the advantages. Okay, so maybe the advantages are even better. Okay, so that's on page 118. On page 118 has, compared to a wholly owned captive, a rent-a-captive program has the following advantages. That might even be more specific. Okay, so you could discuss captives, brackets general, okay, or specific advantages for the rent captive, and that's page. There's a nice page here. It actually has. It literally has all the advantages and disadvantages here. Maybe let me do this even. Take a snapshot. Okay, and let's put that there. Okay, this is page. What page number is this? 118. Page 118 in the emailed file. Okay, is that alright?
Okay, yes.
Okay. Let's check number 6. Number 6, use straight aggregate and franchise deductibles. Okay, that's also from the textbook, from the self-funding chapters. Okay, so straight aggregate and franchise deductibles.
Yeah.
Deductibles. Okay, let's find the deductibles. Okay, so deductibles is on page 15. Not 15, chapter 15, study unit 15, 105. Okay, risk retention. What is the deductible? Types of deductibles, there's it. Okay, so a straight deductible is this. Okay. An aggregate deductible is that, and then we need to find franchise for you. Franchise. A franchise deductible is this. Okay, so at least then I've got all of those 3 notes. Okay, and that all comes from the textbook. This is chapter 15 from the emailed file. Is that one right?
Yes.
Okay, so they said numerical examples. So how would I approach that?
They've got nice examples in the textbook.
Yeah, they
Page
do. Yeah, you could
250.
even use those if you want to. But you could just
250.
you could discuss them generally, like general discussions.
Yeah.
Okay, just remember deductible is self-funding. It's the amount that you pay before you get paid out. Does that make sense?
Yes.
Okay. Right, and then number 7, explain the cover provided under glass insurance. Okay, what is glass, or who is glass insurance best for? Fashion stores, hey?
Yes.
Right, those big stores where you've got all
Retail
those
store.
glass windows and mirrors and everything, hey?
Yes.
Okay, so glass insurance, this would have been covered under commercial insurance, part of motor vehicle and that. Okay, so explain the cover provided under glass insurance. Okay, when you think glass insurance, you're thinking about those big showroom windows and those types of things.
Yes.
Okay, let's try find that here. Glass insurance would have been commercial insurance. Okay. Theft, no. Business interruptions. Buildings, office, multi-peril. Where's the glass? There's the glass. Okay, so glass insurance on page 158 on the old.
186 on the new.
Page 186 on the new. Great. Okay, and they talk about the cover for glass windows, breakage of those. What else? Oh, they even talk about the size, the thickness.
Yeah.
Okay, not for glass over 6 millimeters thick. Okay. The cost of boarding up windows. Okay, all of that. Mirrors. Okay, so that's shop counters. Right. So explain the cover provided. Okay, so glass insurance is obviously going to be looking at windows / display / mirrors / counters, even countertops, and so on. Okay. In your answer, also refer to the sum insured and rating of these policies. Okay, and that's also on the same page.
Yeah.
Okay, so the sum assured, the policy is subject to average. Okay, so an average is used. Okay, because remember, do you agree, not all the mirrors and glasses are going to break?
That's true.
Okay, so an average is used. So I'm not going to insure every single glass window or every single mirror in the fashion store. Okay, I'm only going to look at an average. Okay, and then obviously they also said the rating. Okay, so the rating here would be a percentage of. Okay.
Okay.
Is a percentage of. Alright, and that's pretty much it. I think that was the last one, hey?
Yes.